Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 14th of October. I'm Daniel Lam, your host for the podcast. Recently, I took my son to a prominent global burger chain. Well, there was certainly less of a human touch versus the times when I was a kid, because nowadays you do order via the machines. Now, one of the biggest, if not the biggest, war of worries since Trump took office for the second time is inflation. But so far, this concern does not seem to be as lethal as many had been predicting in the earlier part of this year. Technological advances and the use of AI is a very potent counteracting factor. Now, many were concerned about how tighter immigration policies in the US would lead to a labor shortage gap, and therefore putting potential upward pressure on wages. But so far, we're only in a low hiring and low firing mode. The burger chain example is also evident in many other industries. Technology can dampen the demand for labor, there's less pressure to raise wages, and companies may improve upon their profit margin. So this explains why US exceptionalism is shaken but not stirred, despite the policy uncertainties from the Trump administration. In fact, US technological prowess can be a key risk factor against the weak US dollar thesis. So over the last 50 years, there has been a broad correlation between long swings in US dollar strength and productivity growth. The rapid productivity gains lead to high profit, followed by strong capital inflows. Inflation under control from the improvement in efficiency, i.e. room for the Fed to be cutting rates, leading to lower short-term yields relative to long-term yields, and this reflects the optimism on the US's longer-term growth prospects. So this means high real yields and therefore discouraging hedging on US dollar investments. From our perspective, technological leadership is a key reason why we are overweight US equities, and medium to long-term investors can be adding on dips. It is an important reason why US equities command a valuation premium over equities in the rest of the world. The US earnings season, which begins in earnest this week, would provide the next catalyst for US equities and giving rise to more granular themes within US equities. Now, granted, the latest bout of trade tensions between the US and China is going to lead to concerns of stagflation. US counter moves at a time when their macro data, such as non-farm payroll, have been weakening, and there can be concerns about the return on inflation. But ultimately, we believe the Trump put is intact, and he can de-escalate the tension to support the economy and risky assets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.